But it does mean that corporates, rather than looking to raise debt, are increasingly looking to IPOs and to raising money from equity markets rather than debt. Let's get back to Nina Trentman, who is our senior editor in New York. And Nina, you've stayed up late for us on a really interesting story, so thank you for being with us. Had some trouble with the line earlier. Why does it make sense, do you think, for businesses to look to equity markets rather than, as one might traditionally, to debt markets to raise the capital they need?
Yeah, I think one important consideration for companies is, of course, always this sort of where can you raise capital in the most effective way. And what we've recently been seeing is actually that companies have been looking more towards the equity markets again, both towards IPOs as well as secondary share sales, as they're seeing that IPO markets and equity markets have been showing more signs of life. Recently, we've seen both the S&P 500 and also the Euro stocks up quite significantly over the past year. And so that is an interesting option for companies, especially also as interest rates as of now are still at year highs here in the US at like 2-decade highs. And so this alternative option that during the past 2 years when IPOs were very slow wasn't really there is now coming back into the forefront for companies.
So what are the considerations for executives then when they're weighing whether to raise equity or debt?
Of course, it depends a bit on the type of business that you are. So the amount of debt that you already have, plus the interest rate on that debt, plus also the question as to which industry are you in, and are you in an industry where you expect that the investors will be interested in buying your shares. So one company that we spoke with for this story was an Australian copper business where they had a listing in the US and wanted to tap Australian investors because of copper being such a strongly sought after metal right now, and where basically the company was saying the market was screaming for a copper name to be out there. And so the company that already had high amounts of debt was saying, okay, well, we'll tap the equity markets to bring down some of that debt, to raise capital to pay down debt, and then to improve the capital structure. So of course, it's always a company by company consideration that you have to make as CFO.
Yeah, indeed. So then what kind of IPOs do investors prefer in the current environment? I mean, you've given that one example, raising equity when people want it in order to pay down debt. But what sort of kinds of IPOs are investors looking at?
Yeah, we've spoken to a few investors and fund managers for the story. And what they told us was very much this, that they prefer IPO candidates that have a growth story. So basically where there's a promising technology or they have a promising IP as an intellectual property, which would make investing in that business not just a good way to raise money for the company, but also an interesting proposition for investors. So what we've heard quite clearly, for example, from Amundi Asset Management was this, that they were saying we look for IPO candidates that promise us growth. We don't necessarily just want to be seen as the providers of capital to help companies delever their balance sheet, which of course from a company perspective is what you want to do, but from an investor's perspective, that's not really what you're looking for.
What about private equity firms in all of this, Nina?
Yeah, private equity firms are interesting given that, of course, we've seen in recent years private equity firms being very active, especially when we were during that period of time when interest rates were very low. And so debt came at virtually no cost to many businesses. During that time, PE firms bought assets and loaded them with debt. And the idea was to bring these companies to the public markets, and you would see some sort of benefit from interest rates falling as then the interest bearing debt that some of these companies had would come down with many of them having floating rate debt. Now, with interest rates still pretty high, that consideration doesn't really work out so well. But still, at the same time, we're expecting some of those businesses to come to market, some of the PE owners saying, okay, well, it's a good market for IPOs, especially here in the US right now, so we'll consider our options. That's also what we're expecting, sort of just because there is a fair amount of PE firms that have held their assets for 4 years or more, which is usually the time period during which a PE firm would want to IPO, or then, if not IPO, then sell on its asset.
Yeah, absolutely. Nina, thank you so much for being with us this morning. I'm really glad to have you on the programme. Nina Trentman is the senior editor in New York for Bloomberg, and bringing us that story then on IPO markets, and so corporates trying to tap the equity markets rather than debt. Nina explaining why that's been such a phenomenon.